Well, consumer inflation numbers out a short while ago have again surprised to the downside, with the consumer price index rising by just 3.5% in the year to August. That's down from 3.7% in July. The market was looking for a reading of about 3.6%. Well, joining with more is Russell Lamberti. He's economic strategist at ETM. Russell, thanks very much for coming in today. What were your expectations? Because it looks like the market keeps on getting it wrong.
Market keeps just overestimating the inflation forecast. But when you add it up cumulatively over the past year, it actually amounts to an inflation rate that is significantly lower than the market ever expected it would get to. Our forecast was for 3.5%, so we were on it this month. I think it's very difficult to get it exactly right around that figure, but certainly what we are seeing is consistent underperformance of CPI, as it were, below the market expectation, and I think it's something that the participants in the market need to get increasingly used to.
Where is it coming through from? Which components are really undershooting the mark?
Well, I think there's certainly a sense that general underlying price pressures are on the wane. Certainly services inflation is starting to diminish. We've got a petrol price environment that's going nowhere. Oil prices offshore very stable. A strengthening rand, if anything, means petrol prices will start to, will continue to fall below that 8 rand mark per litre. So I think, overall, yes, people will refer to things like electricity and various administered prices and so forth, but the overwhelming force is for a disinflation environment. So I think we're really starting to see that across the board.
What are the implications of this? Because if we do keep on undershooting, we could get to the very bottom end of the target of 3 to 6%. We're getting pretty close to that point at this stage. Yeah. Implications of this for interest rates, perhaps?
Well, I think that we'll break below 3%, and then I think the Reserve Bank has some big decisions to make. That probably materializes more as a reality early next year than necessarily this year. So what we're seeing on the inflation number currently is some base factors, some statistical factors that are coming through, to the degree that even if we see month-on-month price deflation, we would probably still see year-on-year inflation staying around that 3 to 3.5% mark. But the bottom line is that inflation is trending lower, and I think if you just sort of pull the lens back a bit, it leaves the Reserve Bank with, certainly from its mandate, very few other options other than to cut rates further. And to intervene in that way.
And of course, if you couple it with what we're seeing with the rand at the moment, and obviously the rand at the moment is one of the reasons why inflation is so benign, but with the rand below 7 rand, we've heard that gold mines aren't going to be very profitable if we see the rand getting any stronger than this. So they've really got to look at the rand's levels as well, haven't they?
Well, I guess that's the stated kind of aim, and I suppose that a Reserve Bank, if it's true to its policy goals, would want a rand that's fairly stable. We've been talking at ETM, looking at the fact that trade probably amounts to about half of GDP and exports to about half of that. So when we're aiming for a weaker rand, we're really trying to benefit a quarter of our economy. What about the other 3/4? The other 3/4 are benefiting from a strong rand. Consumers are benefiting from low inflation. Their real incomes are improving. We're starting to see retail sales improve as a result. People get, basic foodstuff prices, if anything, are actually starting to fall. That's freeing up disposable income for other goods and services. So this is actually the route to our recovery. And so, ETM's view is that, focusing on this rand issue is really, it may be something the SARB is going to do, but it's certainly not something we would prescribe.
Do you think it's something that's going to come up in the medium-term budget policy statement next month, that they are going to look at the rand and perhaps change their policy on how we approach this rand? I've been reading in the press about currency wars, with Brazil looking at the real, and of course Polish zloty also looking very expensive, very expensive at this stage, and looking for measures to try and curb this strength.
Yeah, look, and this is an issue that countries are facing, and it's going to get more intense. So we're going to see more foreign capital inflows, more portfolio flows into stocks and bonds. We're going to see rallies across asset classes, and this is going to pose a big issue. And I think the big thing is that as we see currency debasement across the G4 on the major currencies, the question that South Africa needs to ask from a policy perspective is, are we also wanting to import those same monetary policies, that same kind of inflationary monetary policy bias, debase our currency, get into a kind of race to the bottom type scenario? I think is a fool's game. So, it's very difficult to say what's going to come out at that medium-term budget policy statement. My sense is that they're going to allude to the currency. They might even talk about, various policy desires that they might have. Whether they come out with a full-on Tobin tax or something like that, to my mind, is right up in the air. Possibly, if we're looking for a good development to come from that, we'd look for the scrapping of exchange controls outright and actually look to free up this market a bit more, and we'll see what that does to the rand.
Why do you think they haven't done that to this point?
I think there's a lot of legacy issues with South Africa's capital control environment. We, through the apartheid regime, we had capital controls. There was, I think, constantly, when you run a weak currency policy, as we've been doing since the early to mid 80s, effectively, I mean, the rand has weakened significantly since then. That is a recipe for a flight of capital and a flight of skills from your country. So we probably needed outbound capital controls just to stem that. So I think there's some legacy issues in there, and slowly we've been ratcheting those down. I would hope that we go all the way and actually abolish them altogether.
You said we could reach the bottom end of the inflation target. When would you expect that to happen?
As I say, I think we're going to see some tricky base effects coming through for another couple of months. So certainly early into next year, I think we could dip below. And I don't think it'll necessarily stop there unless we see the authorities really intervening strongly. So we could go below 3, we could even go below 2. We could certainly continue to ratchet lower as long as money supply growth stays stable and as long as investors find our assets attractive.